Welcome to TradeTheMBI.com. This is John. This report is for the 13th of April, and of course, everyone got excited by the fact that the CPI numbers came in and they were below their expectation, even though they were still ridiculous. That caused a brief shoot up of the market, but then the reality of the conditions that exist kind of set in, so there was some selling. But of course, we got to right about the 50% level right here, and that's attracted some early morning buying as well. But again, like we've talked about, are we making lower highs and new lows? And in fact, that's what's currently happening. The fade off of white MBI, though, with magenta crossing here to start off the day, that could pose a little bit more of a bullish move, as well as we're getting that on the DOC, the steel short-term buyers pushing up with the orange dipping down below. So that may be enough to stave off any disaster for the moment, but you're not seeing a return from mid-term, long-term buyers yet, though we're reaching those extreme levels. If red were down a little bit further, I think it would be a guaranteed pop back up, but that hasn't materialized yet. And we're still below the red line on the extreme, even with where this pop is right now, so keep an eye on that one. We'll see, obviously, the chart intraday setup, but it becomes pretty straightforward because we had that 61% right there at 44.25, and that becomes the flipping point view-wise, as far as being more bullish than less, and still with white leading. This particular point on the MBI, still the general continuation bias to the negative overall, and irrespective of the macro negatives that exist. And there are a lot of interesting things that are going to start to develop, because particularly as we move towards the middle and end of the month, we're going to start to see whether or not some of the impact of interest rates in that are going to continue to put pressure, because the further interest rates rise, the more attractive that becomes. We had a horrible 7-year auction for treasuries and that, so there's a lot of interesting dynamics that are starting to develop. However, cash is still cheap at this particular stage relative to the Fed hasn't actually done anything significant yet, other than a tiny quarter point move, which was insignificant. But I think the recognition that they really don't have a handle on things yet started to become more apparent to the market overall. From an NQ standpoint, it's just below 50%, so that's an easy one as well from a pop-up move going back around to bullish, and it's almost pretty consistent with where the ES is from a 61% standpoint. We talked about the general weakness of tech versus some of the cyclicals that the rotation seems to be moving to. Almost identical from DOC readings, MBI readings, as well as shakeout and that. So we have pretty decent consistency across the markets. From a Eurozone standpoint, well, there you have it, all the way back to the lows, and this is where it really starts to get interesting, because if we break down into further range below this, I think that it starts to become catastrophic from a Eurozone, which would be capital flight, which would be a bonus and a hindrance to both the S&P, because they rely on that exchange rate for some bonus value from the company standpoint, but it would mean a flight of capital towards the U.S., which would definitely be a bonus for stocks in that sense. But I think it points to bigger issues that have more fundamental effect. And this is where you get into those event situations where at a certain point, what's the catalyst that causes things to start to fall apart? And a lot of that still remains in flux, but certainly Russia moving towards asking for actual gold would certainly be one of those chaotic events that for their oil transactions that could send things spiraling very quickly. And you can see gold, as we expected, continuing to make its move, because at that point you get that bifurcation that I've talked about, where the paper trade that takes place mostly for what we see on a lot of the gold transactions would flip to an actual physical market, and that would be a huge dynamic change that would certainly cause gold to skyrocket. And from an oil standpoint, like I've said, anything that's above this $100 barrel mark definitely problematic, because the longer it persists, the worse the conditions are. And then it just becomes a question of at what point do we see if there's either increasing capacity situation or a drawdown in demand. And while you may see crude buildups, and that becomes the real question: is it because of increased supply or just a lack of demand, which certainly translates into lower economic activity? And I think that becomes critical. It's sort of like what I was talking about the other day about housing situations. Like, if you don't see huge numbers for April for housing and that, there's a real problem there, because everyone knows that the Fed is at least going to hike another 50 basis points. So at that point, people should be just sucking up every home they can if they believe the economy is going to continue to move higher, because as you can see, now we're down to 122, interest rates continuing to rise, and that only thing makes things more expensive and provides less purchasing power. So it's one of those where we may flip from a seller's market to a buyer's market very quickly if the April numbers are not something spectacular, and that could really impact a broad range of economic activity throughout well, at least most of America as far as the dynamic goes. And that will be really worth watching. But again, this has not been a surprise in any way, shape, or form, in line with the expectations. From a Bitcoin standpoint, again, that trail off after the initial euphoria of thinking that Russians and everyone else were going to jump into cryptocurrency from that change in policy hasn't proven to be the case. Again, I was talking about a holding above that 36 becomes a critical support level. At 40 at this particular stage, it's still fine. It's just a matter of just playing little waves up and down. But again, I think that as long as the futures market exists for it, it really puts some limitations on where some of these can go unless there's a big disruption. And it's been pretty clean from a chart configuration. No surprises there. ETH the other day, soft, caught a nice bid, filled it all back in because there were a series of positive extremes going all the way right back to the breakout, and then it even filled in further from the original breakout, and then caught some strength a little bit later on in the pre-market here, and both Bitcoin and ETH though outperforming clearly. And again, there's that 30-35 that I have as a previous algo level that's been critical as far as trade above and below. And for the most part, we've been seeing cryptos that really haven't moved a whole lot, but they've really stabilized, which I think is an important element. Yes, you still get variant swings above and below, but from a static standpoint, they've kind of reached a base level of activity. I think that really makes it easier to trade off of. From an ES5K, short that had moved down below, and then Magenta overtook the weight, and that a little bit further on in here with red leading, potential for it to last or even continue a little bit tougher, but as long as Magenta remains well over the 45 level here, that's a long way back down to the 33. We have weight rising as well, but everything from this standpoint so far with DOC green over cyan. Cyan is all the way down into the 7.5 range, and orange having dipped below red from back right before the upswing took place. Those are all bullish at this particular stage, but critical aspect would be watching that Magenta and seeing if it dips back below the 33 level at this particular stage. Not looking like it's going to be doing that. Real quick, for a 5K, you can see the post-market started to catch the little bit of the bid right there in the turnaround, and that's carried itself through, and all we've done is come back and filled back in some of the dip that took place from the plateau that we had earlier in the other day. And we go back to the beginning of the initial move. You can see that's where the excitement when the CPI numbers came through, but pretty simple for us, just to mark positive extremes Actually, I had to reboot some of the lines that I had got erased. But once we popped above it, produced a whole new series of those. Later ones filled in pretty quickly. That started right here. That filled in was actually the one before was a yellow. So the whole move was pretty close to being in an extreme algo event right off the top. And then as we scrolled across, you can see the weakness that came weren't quite filling. But with all of those white NBI leads, particularly up above and then the pivots below, it just led for a nice continuation move. So it became pretty easy as far as a read on that, and then broke through it. And if we slide that all the way back across, you can see we're right back on that same algo level. So it's not a coincidence, no surprise with any of those details. And we just keep playing the volatility for what it is, and I think that that's been part of the play until there's a actual clarity as to whether or not the economy is going to survive, I guess, is what the real issue is. Once the rate increases take effect, how much dampening that will be, I think there's still a lot of hope in these numbers, given where the market is, that the Fed may back off. And that's really the closet kind of hidden support that's taking on. Plus, there's just a flood of cash. Where else are you going to put it? Again, that just really becomes that defining line that we've talked about for quite some time. It's you don't have an alternative. But as like we see with the TLT, as those rates start to rise, it definitely puts tremendous pressure on the market, because people are going to want to return. Obviously, bonds are offering that return. The question, though, in this particular case, is not enough yet to counter where inflation is running. So people aren't going to take the negative yield, and they can still be in stocks earning the potential of better returns, even though the risk is higher. And that becomes a risk analysis that really starts to play amongst the big boys. And they're the ones who are going to make the move. It's not going to be retail, and that you hear so many articles about retail investors pushing meme stocks, things like that. That's not going to be the overall deciding factor on where the market goes. But as always, we'll keep you updated and post additional details on the Skype chat. Trade well. We'll talk to you later.